Hi, good evening, everyone. Thank you for taking time out on a Friday evening and joining us for this webinar. Our topic says, demystifying MLDs, structured products or MLDs as they're often called, are something you would hear wealth managers talk about. What exactly are they? Why are they important for your portfolio? That is what today we have requested Suchitra to share with us. Suchitra Subramanian, she is head trading and risk management at InCred Group. She has 17 years of experience spanning across trading, structuring, and advisory roles. She's been both across buy side and sell side businesses. Previously, she's worked with HSBC Global Private Bank as a senior specialist managing structured products business in Southeast Asia. And before that, she was at Barclays London as a senior trader in charge of managing the structured products trading business. Welcome, Suchitra, and thank you for addressing us and all our clients today. Over to you.
Thanks, Jarna, and thanks everybody for taking time out on a Friday evening. I'm sure everyone is tired and, it's the fag end of the week, but so that's why special thank you for attending this. Hopefully we keep it short, interesting, and then interactive. So please do come up with any sort of questions that you may have on MLDs. I'll try my best to keep it as simple as possible, as clear as possible. Okay. So I'm going to share my screen. Jarna, just give me a thumbs up if you see my screen clearly.
Sure. And any questions that you might have while she's presenting, you would see at the bottom of the screen, there is a question mark icon. You can press there and you can ask your questions.
So what we're going to talk today is equity-linked market-linked debenture. So as the name suggests, I will be discussing what an MLD is. So first of all, to tell you, before we discuss what an MLD is, let's just discuss why we should all consider doing market-linked debentures. And then we can get to what it is, and then we can get to any other questions that you may have. So one of the things is market-linked debentures have a whole host of benefits. I'll go through each of the boxes, but I would say the single most important box in this whole thing is customizable structures, which is at the bottom of this circle over here. By customizable structures, what I mean is you can have payouts and you can have returns that are tailored to your specific view. Meaning that I believe, we're going to talk about equity-linked structures over here. Meaning that the payout of the note is linked to a particular equity-linked index. So for example, let's talk about what we can offer. It's typically on the Nifty 50 index. Now, I believe that the Nifty 50 is going to go up, but not so up in the next 1 year. I can give you a return payoff that will maximize this specific view. On the other hand, I believe that Nifty 50 will go down. I can maximize your return for this specific view. I can basically customize a structure for you based on where you believe that Nifty will behave in the next 3, 6, 9 months, 1 year, 2 year. You can adjust the tenor of your debt instrument or your debenture. So the maturity of the product can be adjusted. The payout profile can be adjusted. So these are highly, highly customizable structures. So you can exactly fit the return that your portfolio needs. You already are, let's say you're long an equities portfolio, you want to protect your portfolio, you want to buy a solution that will help make money when markets go down. That can be structured for you as well. So there are different structures that we can do based on your view of the market, based on what your portfolio requires. The second one would be portfolio diversification. So I'm going to go anti-clockwise. Portfolio diversification, meaning that this typically would kind of diversify or reduce the overall risk or variance of your portfolio because of obviously it depends on the customization that you provide for the structure, but depending on the structure, it will actually diversify. Let's say you have a 100% equities portfolio, you can diversify away the overall risk of your portfolio, the overall, we measure risk of a portfolio by measuring the variance of the portfolio. The overall variance of the portfolio can be reduced by adding such structures to your portfolio. Therefore, on a risk-adjusted returns basis, you have a much better looking risk-return profile for your overall portfolio by inclusion of MLDs in your portfolio. Principal protection, you can design structures, and that's probably something we will be talking about later today, where you put in 100 in your structure, you will get back 100 at maturity. No matter what happens to the underlying equity, you will get 100% back, plus a certain payout based on your view of Nifty. So not only do you get Nifty returns, but you make sure that in a downturn of a market, you are guaranteed that you get your principal back. So you get only positive performance of Nifty, not the negative performance, and that's what we call principal protection. You put in 100 today, at the end of the note maturity, let's say it's 2 years' time, you get 100% no matter what, plus a certain return on the Nifty. You get returns that are different from traditional investment options. This goes without saying because we can design the payoff based on your view and payoffs that are different from a standard equity return. You're safeguarded against negative risk. This was kind of covered in the principal protection area. I would take it a step further to say that not only are you safeguarded against negative risk, but certain structures you can actually enjoy a positive payout when Nifty is negative. So you can also design structures where not only are you safeguarded against negative risk, but you also get a positive return. And that will reduce significantly, that will significantly reduce the risk of your overall portfolio. And finally, lower than equity risk goes without saying, because I have just said in an example where you get only the upside of Nifty, you do not get the downside. Therefore, by definition, this is lower risk than equity. So these are different reasons why you should consider including market-linked debentures. And specifically, we are talking about equity market-linked debentures into your portfolio. The question is, where would it fit in portfolios? Many times, because it is something that is probably less familiar in the markets. Everyone is used to trading bonds. Everyone's used to trading equity. People are not used to trading structured products or equity-linked portfolio MLDs. So the most common question we get asked is, hey, where will the MLD fit into my portfolio? Okay, so my answer is to this question is it can fit any part of your portfolio. If I think of classic portfolio construction, how do we build a portfolio? We look at the market outlook, bullish, bearish, market neutral, right? Like we think it's going to move, but it's going to be range bound. So that's your market outlook. Let's take Nifty. That's my outlook for Nifty. What does my portfolio need? I need regular income, periodic income, or, I don't need the regular income, but I want to participate in the growth of Nifty. Whatever your portfolio needs, and based on your risk appetite, we combine these three and we create a solution. That's classic portfolio management, where you will look at your market outlook, what your portfolio needs, your risk appetite, combine the three, and you have a solution. Every MLD or combine these three inputs, we at InCred can create an MLD solution for you to fit all these three boxes. So the diagram on the left very nicely shows you the various kind of portfolio requirements. The first one being yield enhancement, where I would say it would replace, let's say, debt part of your portfolio where the risk is relatively lower, but what you do get is you do get periodic coupon returns. Right? So we can construct an equity-linked MLD with this kind of a payoff profile. Slightly higher up on the risk spectrum and therefore higher up on the return spectrum is participation-linked products, where we say you can participate in the Nifty 50. This, I would say, would replace, let's say, your large cap equity allocation. And not only would it replace large cap equity allocation, you can replace large cap equity allocation with principal protection. So you can get to participate in the Nifty 50 only on the upside. So this, I would say, I would call it a participation product where you participate in Nifty, you get one payout at maturity. So it's therefore slightly riskier than a yield enhancement product by definition, but you will also enjoy higher returns. And finally, highest on the risk versus reward return spectrum, I would say, is enhanced participation, where you say, look, I don't need principal protection because I'm extremely bullish Nifty. I am ready to take downside participation on Nifty. But you know what? For this, I need to get 1.x% participation. I need to get more than 100% participation on the Nifty. So we can also construct an MLD solution which will give you, let's say, 1.5 times performance of Nifty, but you will have to take some downside risk. So you see, even over here, your risk return is extremely skewed towards the upside. You get an enhanced participation on the upside of Nifty, whereas you get only 100% participation on the downside. So whatever your view, whatever your need, whatever your risk appetite, there will be an MLD solution that can fit into your portfolio. And then there is the whole concept of principal protection, which can, which is kind of thematic. That's like an underlying vein across the different types of solutions that can be provided. Like you can have yield enhancement products with full principal protection, without full principal protection. You can also have partial principal protection. What does a partial principal protection mean? It means you give me 100 rupees today. At the end of the maturity of the debenture, so just like any debenture, you will have a fixed maturity of an MLD structure. So it's not like equity where you just, there is no tenor. Every MLD will come with a fixed maturity, just like any debenture does. So at the end of the tenor of the product, say, for example, it is 2 years, you will get back, let's say, no matter what happens, you get back 100%. That's what we call full principal protection. Partial principal protection is where we say, you know what, we will protect up to a certain buffer, meaning that at the end of 2 years, if Nifty is positive, well and good, we give you 100% back. If Nifty is negative, depends on how negative it is. You can say that up to a fall of 20%, this 20% is a random number I'm telling you, it can be 20, 25, 30, whatever you're comfortable with. Up to a certain negative value of Nifty, your money is guaranteed, your principal is guaranteed, meaning that you give me 100 today, at the end of 2 years, as long as Nifty hasn't dropped below this kind of buffer level, you will get your 100% back no matter what, not no matter what, depending on the Nifty level. The third one would be no protection, which says that is like your enhanced participation kind of product, which says you give me enhanced participation on Nifty, I'm ready to take the full downside risk. And this whole concept of principal protection is also customizable. So we can give you solutions with different levels of principal protection based on your risk appetite, based on your portfolio needs. Now, the box on the top right over here shows you some of the, what we like to call a menu card of solutions. This is obviously not an exhaustive list because these are just common structures that are traded in the global markets for different kinds of solutions. So for example, I won't go through each one of them. Let's go through one example in each of the categories. Okay. So yield enhancement note, fixed coupon, something known as fixed. Now, this is just terminology. It can be called fixed coupon notes. That's what it is popularly known as. It doesn't need to be called that. So I can tell you what the payout is for, let's say, a 1-year structure. Every 3 months, I get a coupon, no matter what. Let's say I get a 5% quarterly coupon. Okay. At maturity, at the end of 1 year, the client will, so you get a quarterly coupon, and at the end of 1 year, the client will be short a put on the underlying. What do I mean by this? By this, I mean that the client gets a fixed coupon every quarter, but at the end of 1 year, if Nifty goes down, the client will lose money. Another example of a yield enhancement product, simpler than this, would be, let's say it's a 2-year product. Every year, I look at the value of Nifty. So today, I decide, let's say Nifty is at, for the sake of example, let's say it's 25,000. At the end of 1 year, I look at Nifty. If Nifty is anything above 25,000, even 25,001, I get a certain coupon. So that is what we call a flat market fixed coupon note, which means even if the Nifty is flat or even if it is at 25,000, I get a coupon. It's not a guaranteed coupon. Nifty needs to be above or at the level that we started the trade on, and then I get a return. So that's what we call a fixed coupon note. So as you can see, you can design coupon levels that are quite attractive. So that's an example of a yield enhancement product. A participation product example would be, I give you 100 today. At the end of the tenor of the product, you get 100 back plus participation on the Nifty, which means I get you whatever the Nifty performs. Okay, I'm going to focus on the capped note over here, which means I get 100, I get your 100, I get my principal back at maturity, and I get the performance of Nifty up to a certain cap level. Or I just get the performance of Nifty. We can design the payout based on your requirement. That's a participation product. It's called a participation product because you get the returns of the Nifty. You get to participate in the equity markets without putting your principal at risk. Market neutral solutions are solutions which are basically whether Nifty goes up, whether Nifty goes down, I will make money. So I will give you a return. It will be a smaller return, obviously, but I can give you a participation on Nifty on the way up. On the way down, I can say whatever the negative participation, let's say Nifty ends at -5, you get a 5% return. Obviously, we have to design the payout such that it is economical and we can actually structure a solution around it. But market neutral solutions basically play the scenario where you expect Nifty to be range bound, but you don't expect it to go too much up or too much down. You expect it to be range bound. Hedging or diversification strategy are basically strategies that typically decorrelate with equity exposure, meaning that usually I make money when the Nifty goes up, but in these solutions, I will make money when the Nifty goes down. So it's a bearish view on Nifty that I'm expressing because I have so much money sitting on a bullish view of Nifty. I'm ready to allocate, let's say, 10% of my portfolio to say, you know what, to protect 90% of my portfolio, I'm going to do a 10% allocation to a structure that will actually make money when Nifty goes down. And there are obviously, when I say others, it could be any payoff that you like. It could be a combination of yield enhancement and participation. It could be a combination of yield enhancement and market neutral. So there are different structures that we can design. But this is just to give you a flavor of, you want to express a view on Nifty, come talk to your RM. They can structure a solution to design that specific view. Now, one of the interesting observations that we make, so this is about how MLDs can fit into your portfolio. Some examples without getting into too much detail, what is the kind of view and how MLD solutions can fit that view. Some observations that we have made typically looking at global markets is structured products in global markets forms around 25% of portfolio allocation. This is a significantly large number compared to what we see in the wealth portfolios here in India. We see very, very, very little. I would say 5% is also an exaggerated number. We see tiny allocation to MLDs. So there, and there is a big gap. And this is why we're trying to wonder why there is a big gap. And, we're trying to bridge that gap by providing you more and more solutions. One of the reasons could be there aren't too many customized or different structures out there in the market. Here at InCred, we are able to customize and design different payouts for you based on your view. Okay. Equity markets forms the bulk of underlyings in the structured products, whether we see the products in India or whether we see it in global markets. Equity underlyings tend to be the bulk of the structured products underlying. Within equity products also, we notice that it's index-linked products more than single stock products. So we will be focusing initially only on the Nifty 50 linked products. Of the different types of payouts, I would say the yield enhancement and participation are the most popular type of payouts. And hedging solutions, which is a bearish view on equities. And I know the world, there are very few people who are, I mean, equities by nature is an optimistic asset class. Everyone likes to have a positive view on equities. But what we've noticed is post-COVID, we've seen people starting to protect their portfolios or allocate at least some part of their portfolios to protection strategies where they're buying hedges, where they're buying strategies which make money on the way down. And this is what we noticed in, at least in HSBC Global Private Bank. And the last point is quite important, where typically structured products tend to be available only to, ultra high net worth individuals through the Premier channel by reducing, the minimum, investment requirement, etc. We are trying to so-called democratize structured products, make it available to everybody to see, to enhance participation in this kind of product, to include more and more MLDs into client portfolios. So this in a nutshell is how MLDs can fit into any portfolio. The equation on the top to me is key, where you can combine the three key inputs for creating a portfolio and create a solution around it. And also the fact that how MLDs are kind of under allocated in portfolios right now, and why we should really consider allocating more to MLDs. So now coming to what is a market-linked debenture. Okay, and I'm going to focus on equity-linked market-linked debenture. So here, by definition, they are equity-linked NCDs with a predefined conditional payout. Now, like any debenture security, okay, you will get your principal back. So there is a principal amount that you have to invest. It's a fully funded instrument like any debt instrument. So today you will put in 100. Okay, this 100 will be given back to you at the end. Like any debt instrument, like any debenture, there will be a fixed maturity, a fixed tenure for the product. At the end of the product, what do you receive? You receive your 100 back no matter what happens, like any debt instrument, right? In a debt instrument, you put 100 today, you get periodic coupons, you get your principal back at maturity. That part will be similar, where you put 100 today, you get 100 back at maturity. The second part is, instead of the fixed coupons, you will have a payout that is linked to the equity markets. We can design, and this is the box, which is the equity derivatives part, which we can design and customize based on your view. Okay, so what we can do, so there are two payouts that you get at maturity. Combine the two, and that's your payout at maturity at the end of the tenure. 100 given today. At the end of the tenure of the product, you get your 100 back plus X. Now that X is dependent on the performance of Nifty. How does that X vary based on the Nifty level is something that will be written in the term sheet. It is, I can't give you one specific example because it will depend on the structure that we design. It could be 100% participation on Nifty, which means you get 100 plus whatever the Nifty does at maturity. So let's say the Nifty does 10% at maturity, you get 100 plus 10 equal to 110. So you put 100 rupees today, you get 110 rupees at maturity. So that X is a payout that is linked to equity, which will be defined as the MLD payout. Okay. How is it structured? Now, this is a bit of in-depth explanation as to how we design a market-linked debenture. Here we've taken an example of a product where you get 17.5%. So you put 100 today. It's a 2.2-year tenor product. At the end of the maturity of the product, you get 117.5. So you put 100 today, no matter what happens, you get 117.5 at the end of the tenure. plus X. So how do you design this product? Okay. How do you design this product is from the 100 that I receive from the client. Okay. I will give 90 to the treasury department. The treasury in turn will go and invest in a combination of bonds. Okay. Such that those guys will return back to me 117.5 at the end of the tenure. That's how I get my 117.5 and I will give it back to the end investor. The other part, which is, so I've taken 90 out of the 100 and given it to Treasury. The Treasury is going to grow it to 117.5 by investing in XYZ bonds. I will take the remaining 10 and I will invest it in the equity markets based on the payout that I have to give you. So if I have to invest it, I will have to do it in equity options. So if the payout is such that I give you participation on the Nifty up to a certain cap, as a trader, I am going to take that 10 rupees and buy and sell call options in the market such that the payout of that structure is equal to the payout that I have promised you in the MLD structure, the payout that is term sheeted in the MLD structure. And the reason I'm able to fund it with just 10 rupees is because that's exactly how the structure has been designed. So at the start of the structure, I know that I have out of 100, I have only 10 to spend on combination of options. How do I spend this 10 rupees on a combination of options that I am able to generate Nifty returns on full 100% of the principal? And that is the job of the MLD trading desk. That is the job of the whole EQD desk here at InCred, where we design solutions where we can take that 10 rupees off the thing and invest in a combination of options, which will generate a payout. And I take that payout, combine it with the payout that I get from my treasury, join those together to give you the payout of the MLD structure. So that's how typically a market-linked debenture structure is constructed. So I'm going to take a pause over here and I'd like to leave it on this slide because I think this is one of the key slides where you need to think of MLDs as natural portfolio allocation solution and very much how it fits very naturally into portfolios, because the way an MLD solution is designed is exactly how you think of portfolio construction, where you look at your market outlook, you look at your portfolio needs, you look at your risk appetite, and you come up with an MLD solution. And just to give you a brief history, we've been active in MLDs, I would say, for maybe close to 2 years now, maybe 1.5 years to 2 years. And we've seen an amazing growth in the issuance volumes, whether it is, through the Wealth platform, through the Premier platform, through, we also have some third-party distributors. We've seen like a year-on-year growth of 65%. And that's because we are able to create solutions that are tailored to portfolio needs. So we're seeing a good growth in this asset class where we see very good adoption from our clients and also clients of other wealth distributors that we have on our panel of distributors. So Janna, I'm going to take a pause over here. I will stop sharing my slides and I will take your guide on how to proceed.